Investing 101. The golden rule: diversify, spread your bets. Don't put all your eggs in one basket. It's gospel, preached from Wall Street to your grandma's financial advisor. But what if it's a lie? What if one of the biggest legends in the game, Charlie Munger, called it a recipe for being average? This isn't financial advice, by the way. It's a high-speed crash course in financial heresy. If you YOLO your life savings and lose it all, that's a you problem. Now let's light this dumpster fire. Boom! There it is, Munger's most nuclear take. Diversification is a protection against ignorance, a direct hit on the entire financial establishment. Was he just an arrogant billionaire trolling the peasants? Or was he dropping a cheat code to the game that most people miss? Let's unpack the source code. To get Munger, you have to understand this isn't just a hot take. It's a full-blown religion, his gospel of concentration. The core belief? You only get a few God-tier ideas in your entire life. The rest is just noise. Munger's strategy wasn't about grinding daily trades. It was a sniper's game. He saw investing like a pro baseball player. You don't swing at every pitch. You wait and wait for that one perfect throw right in the sweet spot. Then you swing for the fences. Your job isn't to be busy. Your job is to be ready to go all in when the alpha opportunity finally spawns. But here's the critical patch. Munger wasn't talking to you or me. He and Buffett split the world into two classes of players. First, the know-something investor, the hardcore grinder. They have the skill, the time, the absolute obsession to deep dive into a few companies. Then there's everyone else, the know-nothing investor, the vast majority who are too busy touching grass to do 80 hours of due diligence. Your entire strategy depends on knowing which one you are. Be honest. This is where the matrix glitches. Mainstream finance, the guys in suits, defines risk as volatility. The chart goes up, the chart goes down. Scary. Munger called that nuts. For him, risk was one thing, the chance of your money going to zero, permanently. A great company stock crashing 50% isn't risk. It's a Black Friday sale, a fire sale on a god-tier asset. This brings us to a term Munger loved, coined by another legend, Peter Lynch: diversification. It's what happens when diversification goes too far, when a good idea turns into a self-sabotaging bug. Here's the problem. Owning hundreds of stocks doesn't just protect you, it handcuffs you. Your best idea, the one that could 10x, gets diluted into nothing. It's death by 1,000 tiny holdings. You're paying higher fees, it's a nightmare to track, and your portfolio just ends up mirroring the market, but worse. You've basically guaranteed yourself a ticket to mediocrity. Congrats. Don't believe me? The data's brutal. The biggest buff you get from diversification happens almost instantly. Going from one stock to just 15 slashes your risk by a massive 28.50%. Now look at the whole dashboard. After 15 or 30 stocks, the benefit just falls off a cliff. Watch this last row. Doubling your holdings from 30 to 60 stocks only cuts your risk by a pathetic, almost immeasurable 0.2%. You're adding massive complexity for zero practical safety. It's a classic case of diminishing returns. So if concentration is so smart, why does every financial advisor on earth tell you to do the opposite? Because Munger's way is a high-stakes tightrope walk with no safety net. It's insanely dangerous, and the standard advice is there for a reason. Let's be real. Companies do go to zero. Remember Enron? That's not a theoretical risk. That's a real-life rug pull. The math is savage. Studies show something like 60% of all individual stocks actually lose money over their lifetime. The entire market's gains are driven by a tiny handful of mega winners. Diversification is your shield against the high probability that you will inevitably pick a loser. The PhDs have a fancy name for this: modern portfolio theory. It won a Nobel Prize. The idea is simple. The market doesn't reward you for taking on dumb company-specific risk, like the factory burning down. MPT asks, why would you take on a risk you don't even get paid for? The theory says you should delete that risk entirely. But the biggest factor is you. It's easy to say you can handle a 50% drop, but to live through it, to watch your life savings get cut in half and not hit the panic sell button, that's a different game. Munger's way requires an iron will and an emotional detachment most humans just don't have. So what's the move? How can a normal person, a chill investor, use Munger's wisdom without taking on terrifying risk? This is where we merge the two and build a playbook that isn't insane. And here's the ultimate punchline. For all his talk about concentration, when Munger was asked what the average know-nothing investor should do, his advice was simple: buy a broadly diversified, low-cost index fund. It's about intellectual honesty. The biggest danger is thinking you're a stock-picking god when you're really not. So what does that actually look like? A killer example is the 3-fund portfolio. It's a masterclass in intelligent diversification. With just 3 simple low-cost ETFs, you can own thousands of stocks and bonds from the entire planet. It's cheap, it's easy, and it's built to capture the market's returns. For most people, this is the way. But there's a modern twist to this. Today, the biggest danger isn't owning 100 random stocks. It's owning 5 different diversified funds and thinking you're safe, when in reality, they all hold the exact same mega-cap tech stocks. You've just created accidental concentration. This brings us to trap number 1, redundancy. The redundant fund collector. You think you're diversified because you own 3 different S&P 500 ETFs. Wrong. You just bought the same 500 companies 3 times and you're paying extra fees for the privilege. You've added complexity for 0 benefit. Let's visualize it. You start with a total US stock market fund like VTI. It's already heavily weighted towards the biggest companies, which today means big tech. This is your baseline. Now you say, I'm bullish on tech, and you add a fund like QQQ. Look what happens. Your portfolio's tech slice just became massive. You didn't diversify, you just doubled down on the same handful of megacap stocks. You made an accidental, super concentrated bet. And the final trap, the mutual fund collector. You own 3 different large cap growth funds. The odds are their top holdings are nearly identical. You're just paying 3 different expensive fund managers to buy the exact same Apple and Microsoft stock for you. That, my friends, is the definition of diworsification. Which brings us to the final and most important question, the one for you. After all of Munger's ideas, the data, and the modern traps, it's time to look under the hood of your own portfolio. So ask yourself, is it intelligently diversified or just accidentally concentrated? Seriously, figuring that out could be the smartest financial move you make all year.